Welcome to Money First CEO, the podcast for business owners ready to run their business like a boss and make their money work smarter, not harder. I'm Harman Johnston, bookkeeper, Profit First professional, business coach, and mum of two from Sydney, Australia. I've built a thriving business by mastering money habits and systems that create real freedom. This show will help you take control of your finances so you can build a business and life that truly works for you. Every episode delivers one powerful takeaway you can action right away for more clarity, confidence, and cash. And from time to time, I'll be joined by special guests, fellow entrepreneurs, experts, and real business owners, sharing their money wins, lessons, and insights to inspire your next move. Because when you put money first, you unlock the options and freedom you deserve. So hit follow, grab your coffee, and let's dive in. Hey there, and welcome back to the Money First CEO podcast, where we believe if you put your money first, the rest will follow. I'm your host, Harman, and today I wanted to ask you a question that might keep you up tonight. If your business doubled tomorrow, would your finances survive? Not would you be excited and not would you celebrate, but would your financial systems, your cash flow, your team, your processes actually hold up under twice the volume? Because here's what most business owners don't realize. Growth doesn't just test your ambition, it tests your infrastructure. And the businesses that collapse under rapid growth aren't the ones with bad products or services, they're the ones with bad financial foundations. Everyone wants to grow. Everyone wants more clients, more revenue, more impact. But very few business owners stop to ask whether their finances are ready for what they're chasing. Today, I want to talk you through what actually happens when a business grows fast, where the financial cracks appear, and how to build a foundation that doesn't just survive growth, but thrives under it. So let's start with the belief that gets most business owners into trouble. The belief that more revenue will fix everything. If I could just have another 100,000 a month, things will be easier. Once we hit that next milestone, the pressure will ease off. More money coming in means more breathing room. I hear this all the time, and I understand why people believe it. Because on the surface, it does make sense. More money in should mean more money available, more options, more flexibility. But that's not how it works, not unless you've got the right structure underneath it. So here's what happens when revenue doubles without the systems in place. Your expenses will double too, sometimes faster, because growth requires investment. More clients means more delivery means more team means more wages, more super, more software licenses, more management time, more everything. And if your expenses were already running at 70 or 80% of revenue, guess what? The revenue doubles and the expenses don't just double, they often grow disproportionately because growth adds complexity and complexity costs money. I've worked with businesses that have doubled their revenue in 18 months and ended up less profitable to when they were smaller. More money coming in, more money going out, and somehow less left over. And that's not a revenue problem, that's a structure problem. And it's one of the most common traps in business. Let me give you a specific example. We had a client consulting firm doing about 80,000 a month, decent profit margin, owner was paying herself consistently every month, tax was set aside, things were working. Then they landed a major government contract. Revenue jumped to 160,000 a month overnight. Amazing. Everyone celebrated, she was happy, but within 3 months, the wheels started wobbling. They had to hire 2 new consultants to deliver the work. They needed new software to manage the increased project load. They upgraded their office space. Subcontractors were brought in to cover capacity gaps. Revenue had doubled, but expenses had more than doubled. And the profit margin that was healthy at 80 grand a month was now razor thin at 160. The owner called me and said, Harman, I don't understand. We're making twice as much, but I'm more stressed than ever. My accounts are all over the place. I don't have clarity because we were doing profit first with her. And it's possible because growth without structure amplifies problems. It doesn't solve them. So let's get specific. If your business doubled tomorrow, here are the 5 things most likely to break. First one is cash flow timing. This catches everyone. More revenue doesn't mean more cash in hand. It means more money moving. But the timing of when it arrives and when you need to spend it gets complicated. You land a big client, you start delivering. You hire people to help, you pay them this week, but the client doesn't pay you for 30, 60, sometimes 90 days. And it's very common with government tenders, unfortunately. So you're spending against money that hasn't arrived. And the bigger the revenue, the bigger the gap. Your team costs more, your direct costs are higher, and the cash isn't there to cover it. I've seen businesses with incredible revenue on paper that couldn't make payroll because the timing of cash in and cash out was misaligned. They weren't unprofitable, they were cash flow poor. And that distinction can sink a business. So if your business doubled tomorrow, could you fund the delivery costs while waiting for payment? Or would you be scrambling to cover the gap? Number 2 is tax obligations. When revenue goes up, tax goes up. the speed at which it goes up catches most people. If you're collecting more GST, your BAS obligations will increase. If you're more profitable, your income tax will increase. And if you're paying more wages, your pay-as-you-go withholding and super obligations will increase. And if you don't adjust your tax allocations to match the new revenue level, you'll end up behind. The percentage that worked at 80 grand a month might not work at 160. Profit first will save you, because if you're allocating a percentage of every dollar that comes in, the tax account scales automatically with revenue. More money in, more tax set aside. You don't have to think about it. The system does it for you. But without that system, you're guessing. And guessing at higher volumes means bigger mistakes. Number 3 is team costs. Doubling a business almost always means more people. And people are your biggest cost. Not just their salary, super, leave entitlements, workers' compensation, software licenses, equipment, training time, management time. The all-in cost of a team member is significantly more than what you pay them. And here's the dangerous part. Team costs are sticky. You can't easily scale them down if revenue dips. If you hire 3 people to handle the doubled workload and then revenue drops by 20%, you've got 3 salaries that don't reduce with revenue. And that's why I always tell our clients to hire behind revenue, not ahead of it. Make sure the revenue is consistent before you lock in the cost. And when you do hire, build the cost into your budget and your allocations before the person starts. Number 4, systems and processes. Whatever systems you have now, they will build for your current volume. Double the volume and things start breaking. Your invoicing process that worked fine with 20 clients a month might fall apart at 40. Your onboarding process that could easily manage manually might need to be systemized. Your Xero setup might need a cleaner chart of accounts, better reporting, or more frequent reconciliation. And your financial management system, if it's casual right now, monthly glances at the bank account, no formal budgeting, no regular reviews, it won't survive double the volume, because the margin for error gets smaller as the numbers get bigger. A mistake that costs you $500 at 80 grand costs you $1,000 at 160, and the stakes scale with the business. Your systems need to scale too. Number 5 is your own capacity, and this is the one that nobody talks about. What about you? If the business doubles, can you handle the financial decision making that comes with it? Can you manage the cash flow? Can you oversee the budget? Can you monitor the margins? Can you stay across the numbers while also leading a bigger team and serving more clients? Because the CEO's job gets harder as the business grows, and more decisions to make, more complexity to navigate, more people depending on you to get it right. And if you're already stretched, already doing everything yourself, doubling the business doesn't give you more capacity. It takes what little you have left. And this is why having a financial team matters. A bookkeeper keeping the numbers clean, an accountant advising on strategies, systems that give you visibility without requiring you to do everything manually. Growth demands that you work on the business, not in it. And if your financial infrastructure requires you to be in it every day, growth will break you before it rewards you. So let's do a stress test. I want you to honestly answer these questions as I go through them. Not what you hope the answer is, what you know the answer is. Question 1, if your revenue doubled next month, do you have enough cash reserves to fund the increased delivery cost while waiting for clients to pay? If the answer is no, your cash buffer isn't strong enough, and that's the first thing to fix. Question 2, are your tax allocations set as a percentage of revenue, so they scale automatically? Or are you setting aside a fixed amount that worked at a current level but wouldn't keep up with doubled income? If it's fixed, your tax account will fall behind the moment revenue grows. Percentages scale, fixed amounts don't. Question 3, do you know your actual profit margin? Not your revenue, your actual profit margin. The percentage you keep after all the costs. Because if your margin is 5% at current revenue, doubling won't save you. It'll just give you 5% of a bigger number, which is still thin. A healthy margin means the business generates real profit. A thin margin means you're one bad month away from trouble. Question 4, if you need to hire 2 people next month to handle the growth, could you afford their full cost of 6 months without any increase in revenue? The new hires don't generate revenue immediately. There's a ramp-up period. Could you carry them through it? If not, you're not financially ready to hire. And growth without the team to deliver it creates a crisis. Question 5, is your bookkeeping up to date and your Xero clean enough to give you accurate numbers right now? Not next week, right now. If you can't see your current position clearly, you can't navigate a bigger one. Question 6, do you have documented processes for the financial side of your business? invoicing, follow up on overdue payments, expense approval, allocation rhythm, reporting, or is it all in your head? If it's in your head, it can't scale. Doubling the business means doubling the volume of financial transactions, decisions, and obligations. So if there's no documented process, things will get missed. Question 7, are you paying yourself consistently right now? If you're not paying yourself properly at this level of revenue, growth won't fix that. It'll just give you more revenue to not pay yourself from. So how did you go overall? If you answered no to more than 2 of those, your finances aren't ready for significant growth. And that's not a criticism, it's a starting point. Because every one of those gaps can be fixed. You just have to fix them before the growth arrives. So how do you actually prepare? How do you build the financial foundation that can handle growth without cracking? Let me walk you through the key pieces. First, get profit first in place. If you don't have it yet, this is the single most important thing you can do. Separate your accounts: income, tax, profit, owner's pay, operating expenses. Allocate with every deposit using percentages, not fixed amounts. So as you grow, the percentages will assist with creating buffers in all the accounts. Now, you ask me why percentages? Because percentages scale. If you're allocating 15% to tax and revenue doubles, your tax allocation doubles automatically. You don't have to remember to adjust. The system adjusts itself. It works at 50 grand and it works at 200. Second, build your cash buffer. You should have 2 to 3 months of operating expenses in reserve, not in your operating account, in a separate buffer account where it's protected. This buffer keeps you alive during cash flow timing gaps that growth creates. When you're spending now against revenue that arrives in 60 days, the buffer covers the gap. Without it, you're funding growth from money that belongs to tax, profit, or your pay. And that's where the spiral starts. Third, know your margins. Pull up Xero, look at your gross margin, look at your net margin, know these numbers, because growth amplifies whatever your margins are. If your margins are strong, growth makes them stronger. And if they're weak, growth will make them weaker. So before you chase more revenue, make sure the revenue you're already generating is profitable. Fix the margin first, then scale. Fourth, get your bookkeeping professional. If you're still doing your own books, or if your books are behind, or if your Xero is a mess, you are not ready for growth because you can't manage what you can't see. A professional bookkeeper gives you clean, accurate, up-to-date numbers. Numbers you can trust to make decisions in real time. And when the business is growing fast, real-time decisions are everything. A week's delay in seeing your numbers can mean the difference between catching a problem and being buried by it. Fifth, build your forecast. A 365-day cash forecast that maps out your expected revenue, your known expenses, your tax obligations, and your allocation target for the year ahead. This gives you visibility on what's coming. So if growth hits, you can model the impact before it arrives. We use Profit First Profit with most of our clients, and it gives us a 365-day forecast. So we can put a prospective income, we can see what quarterly BAS payments are, and if we were to increase team cost, what it looks like down the bottom, what our cash balances will be. And that's the reason our money dates are usually not more than half an hour, because it tells us exactly what we need to know. Now, what happens to the forecast if revenue goes up by 50%? Can your cash flow handle it? Where are the pinch points? What do you need to adjust? These are the questions you can answer in advance with a good forecast. Without one, you're figuring it out as it happens, and that's more stressful and more expensive. Sixth, document your financial processes. How do you invoice? How do you follow up? How do you approve expenses? How do you do allocations? How often do you review your numbers? Write it down, not for you, for the business. Because if the business doubles, you won't be able to do this all by yourself. Someone else will need your help. And they can only help if there's a documented process to follow. This is what we set up through the financial calm system. Profit first accounts, custom allocations, a live cash flow dashboard, the 365-day forecast, the expense analysis framework, and the Money First CEO plan. When a client finishes the 90 days, their financial foundation is built to scale. They don't need to rebuild it when growth comes. They keep running the system. The system handles the rest. I want to finish on something I feel strongly about, because I think there's a narrative in business that growth is supposed to be hard, that chaos comes with the territory, that stress is a price of success. And I don't agree. Growth should feel exciting, not terrifying. It should feel like an opportunity, not a threat. If the idea of your business doubling fills you with anxiety instead of excitement, that's not a growth problem, that's a foundation problem. And when the foundation is solid, growth feels manageable. You know your cash position, you know your margins, you know what you can afford. Tax is covered, profit is protected, you're paying yourself, the books are clean, the forecast is clear. From that position, you can say yes to the big opportunity with confidence. You can take on the new contract knowing your cash flow can handle the delivery period. You can hire the new team member knowing your budget supports it. You can invest in growth knowing it won't destabilize what you've built. And that's what calm growth looks like. Not the absence of challenges, the presence of a system that handles them. I think about the clients I work with who've experienced significant growth after implementing the financial calm system. The difference isn't that growth was easy, it's that growth was controlled. They could see what was happening in real time, make decisions from data. They weren't panicking, they were leading. One client doubled her revenue over about 14 months, and she was like, this is the first time growth hasn't felt scary. I can see everything, I know where we are, and I know we can handle it. And that's the feeling I want for every business owner, the confidence that your finances can keep up. Because a business that grows faster than its foundations can support doesn't succeed. It just fails at a higher revenue. So let me bring this together. If your business doubled tomorrow, would your finances survive? If the honest answer is, I'm not sure, that's okay. But if it means there's work to do, the time to do it is now. Get profit first in place with percentage-based allocations at scale. Build a cash buffer, 2 to 3 months of expenses, know your margins, and fix them before you chase more revenue. Get your bookkeeping professionally done so your numbers are clean and current. Build a forecast so you can see what's coming. Document your financial processes so the business can run without everything going through you. Growth is not the enemy, unstructured growth is. And the difference between the two is the financial foundation underneath it. A Money First CEO don't just chase growth, they prepare for it. They build for it, and when it arrives, they're ready. So your one takeaway this week is go through the 7 stress test questions, answer them honestly, write down every question where the answer was no, and that's your list. That's what needs to be fixed before your next phase of growth. Pick the first one and start working on it this month. That's it for today's episode. Keep putting your money first and the rest will follow. I'll see you in the next episode.
Thanks for hanging out with me on Money First CEO. If you got value from this episode, hit subscribe, drop a 5-star review, and share it with someone who's building their business too. All the goodies are in the show notes, and you can find me on socials for more tips and tools to help you. Until next time, keep putting money first, and the rest will follow.